For most of your life, you have been shown the debt clock. You have been shown the shutdown drama. You have been shown politicians pointing at one another with very serious faces and telling you that the nation is approaching a cliff. Then you wake up the next morning, go to work, buy groceries, pay too much for insurance, too much for housing, too much for health care, too much for almost everything, and the republic does not appear to have collapsed. That repetition does something dangerous to the public mind. It teaches people to stop asking whether the problem is real and start asking whether the problem can matter at all. That is where confusion begins. Because the federal debt problem is real, it is just not real in the way most people have been taught to imagine. Most people imagine a debt crisis the way they imagine a car crash, a hard stop, a burst of glass, a smoking engine, a dramatic scene, a clear before and after. That is not how this kind of debt crisis usually arrives in a country that issues the currency the debt is denominated in. It does not begin with a loud refusal to pay. It begins with a system learning how to hide the cost of excess for longer than common sense would suggest, while quietly moving the burden from the obvious places to the less visible ones. I have spent my life studying not only balance sheets but incentives. And when I look at the United States debt, I do not first see a bankruptcy. I see a transfer system. I see a political theater designed to distract from arithmetic. I see a country that has become comfortable borrowing from the future while training the present to stop expecting to feel the benefit. That last part matters. The government can spend trillions more than it brings in, and ordinary people can still feel squeezed, tense, and poorer than they expected to feel. That sounds contradictory only until you ask a harder question: where did the money actually go? And once you ask that question honestly, the debt story stops being a cartoon about a ticking clock and becomes a story about power distribution, incentives, and time. That is the story I care about, not the performance, not the slogans. Not the usual party script where one side becomes suddenly pious about fiscal discipline when it is out of office, and suddenly forgetful about it when it is in office. I have lived long enough to know that moral outrage in politics is often rented by the season. Debt is no exception. The same people who announce that the nation is on the path to fiscal ruin often vote to expand the borrowing limit when it suits them, back deficits when their preferred programs or tax cuts are on the table, and then return to the microphone to warn the public that someone else has been reckless. That is not reform. That is rotation. And rotation is one of the most reliable ways to keep a broken system alive. If you keep changing the narrator, some people never notice the script stayed the same. Now, let me say something clearly. The United States is not a household. That sentence is abused so often that people either worship it or reject it too quickly. It is true and it is incomplete. The country is not a household in the narrow sense because it issues the currency in which its debts are owed. It does not need to earn dollars before it can, in some ultimate sense, create dollars. That means the federal government is not facing the same type of insolvency risk as a family carrying a maxed-out credit card and no printing press. But that truth does not make the debt harmless. It changes the form of the danger. A household that borrows too much can hit a wall and default. A sovereign that borrows too much in its own currency can often avoid that exact wall. Instead, it tends to choose among softer forms of injury inflation: higher interest costs, currency weakness, asset distortions, slower growth, tax burden shifts, political coercion, financial repression, and a general erosion of trust. Those injuries are less cinematic. They are also more politically useful because they can be denied, delayed, scattered, and hidden inside other explanations. That is why so many people still do not understand what they are looking at. They keep waiting for the debt crisis to look like a household crisis. It may never do that. What it can look like instead is a long period in which more and more national output is consumed simply by carrying yesterday's promises, while the public is told the problem is either under control, exaggerated, or someone else's fault. That is much closer to the truth. People ask Warren, if the government has spent so much more than it has taken in, why does the average citizen not feel richer? That is exactly the right question. If debt were a free lunch, the answer would be obvious. You would see the roads gleaming. You would see the schools transformed. You would see the public healthier, the infrastructure stronger, the average worker more secure, the middle class less brittle, and the future visibly easier to finance. Instead, a great many people feel the opposite. That tells you something important. It tells you that debt has not simply been funding broad social enrichment. A significant share of it has been funding transfer, stabilization of existing power, temporary support for consumption, interest obligations, contract flows, grants, subsidies, asset support, political bargains, and financial plumbing that often benefits the upper layers of the system far more directly than the median family. That is why the public can be told that trillions have been deployed while still finding itself wondering where the prosperity went. The prosperity did not vanish. It was distributed unevenly, captured selectively, and translated through institutions before it ever had a chance to feel like common abundance. That distinction is central. If you miss it, the whole debt discussion becomes childish. You begin to think the only two possibilities are either the debt does not matter or the debt must produce an immediate apocalypse. Neither is true. The debt matters profoundly because of how it shapes the economy even before any dramatic rupture arrives. It affects what gets funded, it affects who gets paid, it affects what rates lenders demand, it affects how much of the budget gets consumed by interest, it affects which taxes must rise, which programs get squeezed, which constituencies are protected, and which political games become more dangerous with each new round. In other words, debt changes the future long before it ever announces itself as a crisis. That is one of the oldest lessons in finance. A burden does not need to explode to become costly. It only needs to compound. If you ask most people what the national debt is, they will describe a giant number rising all the time, as though the country is continuously swiping a card every second of every day. The imagery of the debt clock encourages that misunderstanding. It is useful for grabbing attention, but it is not very good for teaching mechanics. Mechanics matter, not because they are glamorous, but because the moment you understand the machinery, you understand why political theater around the debt ceiling is both absurd and dangerous. The government does not simply hit a wall and vanish when a ceiling is reached. It moves money through accounts. It has a checking account of sorts. It takes in taxes and receipts. It pays out salaries, contracts, benefits, defense obligations, and debt service. When borrowing authority is interrupted, the state does not instantly go dark. It starts juggling cash, drawing down balances, postponing certain moves, using extraordinary measures, and buying time. That is where a lot of the misunderstanding lives. Because once the public sees the government continue operating for a while, people conclude the ceiling must not matter. That is a mistake. The danger is not that the ceiling instantly ends civilization. The danger is that lawmakers have built a recurring hostage situation into the center of the global financial system and then normalized it. I do not admire that. Threatening to force a default or a payment interruption in the name of fiscal responsibility is like refusing to pay your credit card bill because you are trying to become more disciplined. It advertises seriousness while increasing risk. And because the United States sits at the heart of so much global collateral, settlement, reserve management, and pricing, even brief uncertainty matters. Treasuries are not just another bond. They are treated throughout the world as a baseline asset, a form of financial bedrock, the instrument against which many other prices, contracts, risk models, and balance sheet assumptions are built. When you inject political melodrama into the question of whether that bedrock can be relied upon, you are not showing discipline. You are teaching the world that the adults in the room may at some point choose chaos for leverage. That lesson has consequences. Ratings get cut. Borrowing costs rise. Confidence frays. Alternative reserve strategies become more attractive. And even if nothing fully breaks, the cost of maintaining the same system goes up. That is how debt starts to bite. Not always through default. Sometimes through doubt. Doubt is expensive, especially when you have built your prosperity on being treated as the safest intermediary in the world. Now let us move to the part politicians prefer to blur. There are only so many ways out of a debt burden once it reaches a certain scale. You can outgrow it, you can inflate it away, you can tax more, you can spend less, you can drift into a low-growth equilibrium where the system becomes numb rather than healed. Or you can keep kicking the can and hope the road stays smooth enough to keep rolling. That last one has been the favorite for a long time. It is the easiest path politically because it spreads pain across time and turns immediate sacrifice into a tomorrow problem. Tomorrow in politics is an enormously valuable country. Almost everyone campaigns there. Very few govern there, but can kicking the can work forever? No. Can it work much longer than many people expect? Yes, that is why this issue is so difficult. The absence of immediate catastrophe has been interpreted as proof of sustainability. It is nothing of the kind. It is merely proof that large systems can metabolize strain for a while, especially when the strain is distributed and the currency remains dominant. The better question is not whether the country can borrow again next month. The better question is what must increasingly be given up to make that continued borrowing tolerable. That is where the real losses accumulate. Take growth. Growing out of debt sounds elegant because it seems to avoid sacrifice. If the economy expands fast enough, debt becomes smaller relative to output, just as a fixed obligation feels more manageable when your income rises. Politicians love this idea because growth is always popular, and sacrifice is not. But debt arithmetic does not respect speech writing. If your debt stock is massive, if rates are higher than they used to be, and if the interest expense itself is consuming more and more of national output, then growing fast enough to outrun the problem becomes much harder than slogan makers pretend. A family with a modest mortgage can benefit immensely from a raise. A country with a giant debt stock and rising refinancing costs faces a tougher problem. It does not only need headline growth, it needs enough sustained growth to outrun the cost of carrying its obligations. That is a higher bar, and as debt gets larger, that bar rises. What makes this especially troublesome is that interest itself begins to crowd out what growth would otherwise have financed. Money that could have gone toward productive investment, relief, infrastructure, or even simply a slower accumulation of new obligations now goes towards servicing existing promises. Interest is not morally bad, it is not evil, it is simply the price of having brought tomorrow's resources into today. But once that price becomes large enough, the budget starts to change character. It becomes less a plan for the future and more a maintenance contract for the past. That is a dangerous shift. A healthy society should use debt strategically. An unhealthy one begins to live inside debt administratively. It manages it, rolls it, refinances it, negotiates around it, argues over it, posts it on clocks, scares voters with it, then borrows more. That is not masterful finance. That is a civilization learning to normalize drift. Now consider the inflation route. Many people think the solution is obvious. If you owe a fixed nominal amount, reduce the real burden of that amount by making the currency worth less. That is not crazy in theory. Debtors throughout history have been helped by inflation. If you owe fixed dollars and the dollars are weakened, the real burden falls. The problem is that lenders know this too. So once you establish inflation as a habit, future lenders demand higher compensation. The trick only really works cleanly once. After that, the market adapts. Rates rise, confidence weakens, the currency's role can erode. And the domestic public, which is already trying to survive a cost of living crisis, ends up carrying yet another invisible tax. That is one reason inflation is politically seductive and socially corrosive. It can reduce old burdens while planting new distrust. And distrust, once embedded in financing conditions, can take years to remove. If you ask me, a country that uses inflation repeatedly as a substitute for discipline is not solving its debt problem. It is changing the costume of its debt problem. The tax and spending route is more honest, which is exactly why it is less popular. People say, of course, we should cut waste. Fine. Who decides what counts as waste? People say we should live within our means. Fine, which means the modern budget is not mostly made up of optional ornaments. Large portions are tied to health programs, pensions, defense, interest, and commitments that powerful constituencies defend fiercely. Once you get past the applause lines, genuine cuts require conflict, and conflict requires someone with enough courage to offend groups that vote, donate, and organize. That is in short supply. Raising taxes is no easier, not because the country lacks taxable capacity, but because the structure of who pays and who benefits has changed. This part deserves much more attention than it gets. For decades, total government revenue as a share of the economy has seemed strangely stable. People use that fact to argue that taxes cannot solve the issue, and that the burden has already reached its practical limit. That conclusion is too simple. The question is not only how much revenue is collected, the question is from whom. If more of the burden has shifted toward middle earners, wage earners, and people with a high propensity to spend and invest in ordinary life, while more of the upside of government-linked spending flows toward firms, asset owners, contractors, subsidy recipients, and holders of financial claims, then the apparent stability of revenue hides an important change in incidence. In plain English, the wrong people may be doing too much of the paying, while the right people benefit from the spending, and then turn around and lend the government the money to cover the resulting deficit. That is not a trivial observation. It means part of the debt machine is also a power machine. The same wealthy institutions and capital pools that benefit from contracts, guarantees, bailouts, credits, asset support, and public spending often end up holding the debt claims as well. They are paid coming and going, paid through the programs, paid through the financing, paid through the interest. That does not mean every bondholder is sinister. It means the system is not neutral. And once you see that, you understand why the public can feel as though it is financing a structure from which it receives only diluted benefit. That is a recipe for cynicism. It is also a recipe for stagnation. When too much of national policy is organized around preserving asset values, stabilizing large institutions, and maintaining debt service credibility without asking harder questions about distribution, productivity, and middle-class resilience. You can get an economy that still looks rich on paper while feeling brittle in daily life. That is where the United States has been drifting. The wealth exists, the dynamism exists, the innovation exists, but the broad ease does not. That discrepancy should tell you something. Debt at this scale is no longer just a number. It is one of the forces shaping why the discrepancy persists. There is another path countries sometimes take. They become a version of Japan. Not in cultural terms, in financial terms. Low growth, low inflation, or at least subdued demand, heavy debt, low rates sustained by domestic structures and policy, a society that avoids immediate chaos, not by solving the problem, but by settling into a kind of managed heaviness. People hear that and assume I mean disaster. Not necessarily. It can be orderly, it can be peaceful, it can even be wealthy in certain respects. But it is not the same thing as vibrant compounding. It is more like sedation. The debt remains large, growth remains restrained, the system continues, but the sense of broad upward energy softens. For a nation used to selling itself as the engine of the world, that would be a profound psychological shift, even if it were financially survivable. Now let me address the most common mistake ordinary observers make. They assume that because the United States has never truly defaulted, and because it can ultimately print dollars, lenders have nothing to fear. That is not correct. Lenders do not mainly fear literal non-payment. They fear the terms on which they are repaid. They fear that a dollar received later will buy less. They fear that political games around ceilings and shutdowns will introduce uncertainty into an asset class supposed to anchor certainty. They fear that reserve diversification will continue. They fear that deficits, rates, and refinancing needs will push yields higher. They fear that the currency and the collateral regime built around it might not remain as unquestioned as it once was. Those are real concerns. And when lenders have real concerns, they demand compensation. That compensation shows up as higher yields. Higher yields mean more interest expense. More interest expense means more borrowing, or more cuts, or more taxes, or more repression. The snake begins to eat itself, not in one bite. In loops, the loop is what matters. You cannot discuss debt honestly without discussing reflexivity. The larger the debt burden, the more sensitive the budget becomes to rates. The more sensitive the budget becomes to rates, the more markets watch politics. The more markets watch politics, the more every debt ceiling show, every shutdown threat, every downgrade, and every policy confusion matters. The more it matters, the more expensive borrowing can become. And the more expensive borrowing becomes, the less room remains for everything else. That is what I mean when I say the real crisis is not tomorrow's default. The real crisis is a slow migration of national capacity away from productive use and toward maintenance of the debt structure itself. It is like owning a grand estate and discovering that more and more of your income each year must go not toward improving it, expanding it, or enjoying it, but simply toward keeping the claims against it satisfied. At first it feels manageable. Then one day you realize the estate is working for the debt more than the debt is working for the estate. Nations can reach that point too. When people say, "Warren, but the government can always print," I answer yes. And a ship can always throw cargo overboard to stay afloat. The question is what kind of voyage you are left with after doing so. Printing solves one kind of failure by inviting another. Borrowing solves one kind of constraint by inviting another. Even taxation, done clumsily, can choke the very growth it hopes to preserve. There are no magical exits once the obligations become enormous. There are only trade-offs. And political systems built on promising painless outcomes tend to postpone trade-offs until they become uglier. That is why I have little interest in debt commentary that speaks in absolutes. The useful questions are always comparative. Compared with what? Who pays first? Who pays later? Who gets insulated? Who absorbs inflation? Who captures spending? Who collects interest? Who receives contracts? Who benefits from tax preferences? Who is asked to tighten his belt after years of being told the country could have everything at once? Those are the real debt questions. Everything else is wallpaper. One of the most revealing facts in modern American life is that many wealthy institutions could clearly afford to finance more of the public burden directly because they are already financing it indirectly by buying the debt. That sounds like a throwaway line. But it is not. If capital can be found to purchase Treasury securities, then capital exists. If firms can benefit from public spending flows and then recycle that gain into holdings of government obligations, then capacity exists. The problem is not that the money is nowhere. The problem is that the present arrangement is profitable for enough powerful people that reform is easier to describe than to enact. This is where debt becomes political economy. A broken system can survive for a very long time if it distributes enough rewards to the right gatekeepers. And America's debt system has done exactly that. Banks need high-quality collateral. Funds need safe assets. Institutions need benchmark instruments. Politicians need room to promise. Contractors need spending. Large asset holders need a stable structure in which public commitments support private valuations. No one person designed the whole loop that makes it stronger. Decentralized interests often protect a regime more effectively than one mastermind ever could. So what happens to the ordinary citizen inside all this? He pays in fragments. That is the genius and cruelty of the system. He pays through inflation when it appears. He pays through weaker public capacity because interest consumes fiscal room. He pays through tax structures that lean on work more heavily than wealth. He pays through housing distortions, healthcare strain, education costs, and a political class that keeps promising benefits while refusing to describe the true financing conditions. He pays through a slower improvement in the things that ought to matter most. He pays through fragility. The fragility is the real bill. People often imagine debt pain as a future event. For many families, it is already a present condition. If your country spends massively, and yet your own life remains highly exposed to ordinary shocks, that tells you the spending has not translated into sturdy personal balance sheets. Why not? Because much of it was never meant to. Some spending softens collapse. Some props up systems. Some rescues institutions. Some secures constituencies. Some enriches intermediaries. Some is necessary. Some is wasteful. Some is captured. But very little of it arrives as a lasting widening of the average family's margin for error. That is why the public feels a strange dissonance. The nation seems rich. The people feel constrained. Both observations can be true at once. Debt has helped hold that contradiction together. Now, I want to say something that may sound severe. A society can go a surprisingly long time without reform if it can keep convincing people that each new emergency justifies one more round of postponement. War crisis, pandemic, recession, financial instability, strategic competition, industrial policy, energy transition. There is always a reason. Sometimes the reason is legitimate. Often it is. But when every legitimate reason leads to another layer of debt without a corresponding political willingness to discuss durable funding, then emergency stops being an exception and becomes the organizing principle of the state. That is not sustainable in a moral sense, even if it remains arithmetically survivable for years, because living permanently in emergency changes how leaders behave. It changes how markets price risk. It changes how citizens think about sacrifice. It changes what kinds of lies become normal. You begin to hear that no one can touch any major expense. You begin to hear that no tax increase on powerful groups is feasible. You begin to hear that growth alone will save the day. You begin to hear that today's borrowing is fine because tomorrow's prosperity will surely be larger. You begin to hear that reserve currency status is permanent. You begin to hear that interest is manageable right until it becomes awkward. This is how empires talk to themselves when they are trying to delay discomfort. They do not always know they are doing it. That makes the process more dangerous, not less. There is one more feature of the debt story that deserves respect. The greater the debt, the more every self-inflicted political game matters. Once you have stacked the tower high enough, even a foolish shake can have consequences. The debt ceiling standoffs, the shutdown dramas, the manufactured deadlines, the performative outrage. All of these things might look ridiculous, and they are ridiculous, but they also interact with real markets. A downgrade is not a joke. A delayed auction is not a joke. A wider yield demanded by lenders is not a joke. A fraying assumption that treasuries are pristine under all conditions is not a joke. And because the debt is now so large, small shifts in rates can translate into enormous shifts in annual interest cost. That is the part people underappreciate. At modest debt levels, rate moves matter less. At colossal debt levels, rate moves become national events. You do not need a debt spiral worthy of a textbook panic to feel the damage. You only need enough rates pressure to redirect more and more budgetary oxygen toward debt service. Then the whole political system starts fighting over a shrinking zone of discretion that is already happening. Interest does not vote. That is one reason it wins. Nobody runs a campaign on behalf of bond coupons for old borrowing, but the coupons get paid anyway. Meanwhile, every live constituency fights for what remains. That makes politics nastier and reform harder. So if you ask me when the debt becomes a problem, I would say it already is one. Not because default is imminent, not because some giant red clock finally hit a magic number, but because the nation is devoting too much ingenuity to preserving the illusion that it can postpone the argument forever. There is a cost to that posture. The cost is not just financial, it is cultural. It teaches the public that arithmetic is negotiable until it suddenly is not. It teaches politicians that performative seriousness is a substitute for actual sacrifice. It teaches markets that U.S. dysfunction must be tolerated because the alternatives are imperfect. It teaches citizens that nothing can be changed, which is one of the most corrosive lessons any democracy can absorb. I do not enjoy speaking in that register, but age has made me impatient with pretty evasions. The country can solve much of this if it chooses. It can tax more honestly. It can spend more intelligently. It can rethink incentives. It can slow the addiction to emergency justification. It can reduce the political weaponization of the debt ceiling. It can aim public spending more directly at broad resilience rather than assuming that enough private prosperity at the top will trickle into stability below. It can do these things. What it has not yet shown is the will to do them before the market forces harsher terms. That is a different problem. And markets do not ask for permission. They simply change the price, that is the final judge in debt, not the speech, not the press conference, not the latest temporary deal. The price, what rate must be paid to borrow, what yield must be offered, what share of the budget vanishes into interest, what portion of national income is diverted from future building into past maintenance. Those are the real verdicts. Right now, the verdict is not catastrophe. It is warning. Warning that the debt can still be carried, but not costlessly. Warning that reserve status is a privilege, not an entitlement. Warning that tax incidence matters. Warning that public spending captured by private power does not feel like public enrichment. Warning that political games around the ceiling are much more reckless at this scale than many people admit. Warning that interest burden can become its own driver of fragility. Warning that a nation can remain rich while its citizens feel progressively less secure. If you wanted to build a responsible national conversation, you would begin there. You would stop telling people fairy tales. You would stop implying that one party was pure and the other reckless. You would stop acting as though debt is meaningless until it becomes fatal. You would tell the truth that the burden is already here, only diffused. You would explain that all exits involve trade-offs. You would show how the burden has shifted. You would ask who has benefited from the current arrangement and who has carried the hidden bill. And then you would make choices, real ones, not theater, not seasonal conviction, not another round of chicken with the global collateral system. Real choices: cut what is unproductive, tax where capacity genuinely exists, protect growth by easing the burdens on work and productive risk taking rather than always cushioning entrenched claims. Reform the debt ceiling ritual into something less insane. Use debt where it widens future capacity, not merely where it postpones present discomfort. Those are the kinds of principles I would respect. Will they all be followed? Probably not. But the absence of perfect reform is no reason to accept childish thinking. The debt is not a myth. It is not a harmless scoreboard. It is not an automatic collapse machine either. It is a slow force that shapes the country's room to maneuver. And room to maneuver is one of the most valuable assets any nation has. Once that room narrows, everything becomes harder. Every shock hurts more. Every rate move matters more. Every policy error becomes more expensive. Every political game becomes more dangerous. That is why I take the issue seriously. Not because I enjoy alarmism. I dislike alarmism. I dislike simplistic comparisons too. America is not Greece. America is not Argentina. America is not a family kitchen table. America is a large, productive, still immensely privileged state with deep capital markets, great innovative capacity, military reach, cultural influence, and the reserve currency. That is exactly why it has been able to postpone the full feeling of its arithmetic for so long. Privilege extends the runway. It does not abolish gravity. A smart investor knows the difference. So does a smart citizen. The debt will become a full-blown crisis only if enough people remain committed to acting as though all the warnings are just entertainment until price, inflation, rates, or political breakdown imposes discipline from the outside. That is not inevitable, but it is possible. And even before that, the debt can continue doing what it is already doing, reshaping priorities, enriching some layers more than others, consuming fiscal oxygen, encouraging bad politics, undermining the clean reputation of the nation's obligations, and making the average person feel as though an allegedly wealthy country somehow cannot quite afford to make ordinary life feel secure. That contradiction is not random. Debt is not the only reason for it, but debt is one of the engines. If you understand that, you no longer need the clock to scare you. You no longer need the shutdown circus either. You can ignore the costumes and watch the cash flows. You can watch the interest expense. You can watch who pays. You can watch who gets protected. You can watch whether growth is broad or merely financial. You can watch whether borrowing creates future capacity or only buys temporary calm. Those are more useful habits. They are less entertaining than cable television. They are much better for preserving judgment. And judgment is what this country needs most in debt matters, not panic. Not complacency judgment. A nation can survive debt for a long time. What it cannot survive indefinitely is the habit of pretending that the distribution of the burden does not matter. That is always where the true bill arrives, not when the clock flashes a bigger number, when the public finally realizes that it has been paying for years in ways nobody bothered to name honestly. That realization, when it comes, changes politics very quickly. Until then, the debt story remains what it has been for some time. A giant arithmetic fact wrapped in theater, cushioned by privilege, extended by inertia, and paid for in fragments by people who often have no idea how much of their fragility is connected to it. That is the truth I would keep in mind. And once you see it that way, you stop asking when the debt problem begins. You begin asking how much of national life has already been bent around avoiding the admission that it began long ago. The answer to that question is more uncomfortable. It is also more useful, because useful truths are rarely the ones painted on giant clocks. They are the ones hidden inside budgets, incentives, tax burdens, yields, and the ordinary exhaustion of a country that keeps borrowing in the name of tomorrow while asking the present to believe everything is still under control. I do not believe in fairy tales about money. I believe in compounding. The debt compounds. The interest compounds. The political habits compound. The evasions compound. Eventually, the price of all that compounding is paid somewhere. My concern is simple. I would prefer a country like this choose where to pay it while it still can.